Hi there, Kai Potter with Champion Brokerage Group. So the purpose of this video is super simple, right? It's to give you clarity so that you can go to the market and choose the right kind of life insurance for yourself without getting sold something you do not need. Did you know that there are really just two kinds of life insurance? But they show up under 5 different names. There's term, whole life, IUL, mortgage protection, and then final expense, all tracing back to either temporary or permanent coverage. You pick the wrong type of plan and you could overpay for decades. So if you pick right, you can buy exactly the type of protection that you need. In the next few minutes, I'll decode those 5 labels, show you the job that each one does, and quickly walk you through how exactly the applications work. There are multiple types: express, full underwriting, and even graded or guaranteed issue. And those typically have waiting periods. So you can choose with confidence. By the end of this video, I promise you that you will not be sold a policy because you'll know exactly what to ask for, what to avoid. Here's a quick roadmap to what we're going to discuss. We're going to talk about what each type of insurance does, who it's usually best for, the big pros, and then what to watch out for, and also to discuss what to expect when you go to apply. Let's go. So let's think of life insurance in 2 big buckets, right? There's temporary protection for a set number of years, usually the most budget-friendly way to get a lot of coverage. And then there's permanent protection, which is designed to last an entire lifetime. And it also may help build cash value. There's mortgage protection, which usually uses term. Final expense is usually a smaller whole life plan. Let's first talk about term life. So term life gives you coverage for 10, 20, or a maximum of 30 years with level premiums for that specific period. It's great for income replacement, covering a mortgage possibly, and protecting the kids during our highest responsibility years. The pros are that you get the most coverage for your dollar, and it's super easy to understand. But here's what to watch out for. When the term ends, your coverage also ends, and it gets super expensive to continue the plan. So we have to make sure to ask about conversions. Many term policies will actually allow for you to convert the plan into a permanent plan within a window. You just have to know in advance. Whole life is permanent coverage with guaranteed premiums, guaranteed death benefit, and guaranteed cash value per the contract itself. With some insurance carriers, you may receive dividends, but they're not usually guaranteed. Those dividends can enhance performance. This is probably best for lifetime coverage, legacy and estate planning, and people who want a long-term predictable plan. But what should we watch out for? Well, it's more premium per dollar of death benefit than term. And you want to make sure it's designed correctly. Third, Index Universal Life is also a permanent life insurance plan where your cash value earns interest and it's tied to the performance of the market index, sort of like the S&P 500, but you're not actually invested in the market. Think of it as an index-linked credit in good years and a floor in bad years. Your floor is typically 0%, so when the market is negative, or the index is negative, generally your account will credit 0. That's before any policy charges. The upside you receive is also limited by a cap, participation rate, or a spread that's usually set by the insurance carrier. The flexibility is that the premiums and death benefit can be adjusted within the contract limits. Just make sure to keep enough value to support the policy. It is so important to design this plan properly. And it's usually best for people who want permanent coverage with potential for index-linked growth, plus flexible funding options. It can be designed for future policy flexibility or to supplement income via loans or withdrawals later down the road. The pros are that your downside has a floor of 0%. There's tax advantage growth inside the policy, flexible premium options, and benefits with the optional riders. And it varies by carrier, of course. What are we watching out for now? The charges and the cost of the insurance does reduce your values. The caps, participations, and spreads can change over time. Your policy loans also accrue interest and reduces your cash value and death benefit. So Poor funding could, or unmanaged loans could cause a lapse. Remember, this is not a market investment and typically doesn't credit stock dividends. In plain English, for example, if the index is down 12% and your floor is 0, your segment credits your account 0%. Then your policy charges will apply. If the market is up 18% and your cap is 10%, for example, that segment credits 10% before charges. The results will vary, obviously, by strategy and also the insurance carrier. Returns are index linked, not market returns. Loans, withdrawals will reduce your policy values and may cause a lapse. Mortgage protection is a strategy to cover your home if an income earner passes away. Most families uses level term matched to the mortgage amount and the years owed. Final expense is typically a small whole life plan. Think $5,000 to $30,000. It's focused on end of life costs. It's often simplified issue, meaning there's no medical exam for many people, just health questions and data checks. It's really designed to be simple. It's permanent and budgetable. Things to watch out for: it's higher cost per dollar of coverage, and depending on your health, it may have a graded or modified benefits with waiting periods. Let me explain those terms now because they're also pretty important, right? Waiting periods: graded, modified, and guaranteed issue. Level benefits means day one coverage for natural and accidental causes, subject to standard contract provisions. Graded benefits mean you get partial natural cause coverage in the first 2 years. For example, a percentage of the death benefit in year 1 and a higher percentage in year 2. Accidental death typically pays full benefit day 1. Then there's modified or return of premium, which means in the first 2 years, for non-accidental death, the policy may pay back premiums plus interest, commonly around 5 to 10%. Again, accidental death is usually covered in full day 1. Guaranteed issue, or GI, is for people who can't qualify elsewhere. There are no health questions or exams, but there's typically a 2-year waiting period. And the waiting period is for non-accidental death. Return of premium plus interest or a graded payout after the waiting period, you're at the full benefit. Waiting period details vary by carrier and also states. Accidental death is often covered at day 1. How applications work. Let's talk about the application process so you know what to expect. The first, express, simplified, or accelerated. The names really vary. This can be fast, sometimes the same day or to a few days. Usually no exam is required. The carrier uses an electronic data prescription and they check for MIBs, prescription checks, and a health questionnaire to make a decision. It's great for final expense, mortgage protection, and many term or permanent cases up to a certain limit. B is full underwriting, which is going to be slower, often from 2 to 6 plus weeks, and may include a paramed exam, labs, and also doctor records. The trade-off is you get access to a higher face value or death benefit amount, and potentially your best rate class if your health supports it. This is common for large income replacement term, high face value life or index universal life, and business or estate cases. Finally, there's modified, graded, and then guaranteed issue, which is what we use when health is a hurdle and a standard or express approval isn't likely. You still get coverage, but there are early year limits. Usually a 2-year waiting period for non-accidental death with a return of premium plus interest or a graded payout. It's easier to get, but it's higher cost per dollar of coverage. Here's some tips to speed up that process. Have your doctor info and medications ready. Answer honestly and completely. Omissions will slow things down. Stay reachable for quick follow-ups. Choose the right fit. Match the policy to the job you need done. Big income replacement on a budget, that's going to be term. Lifetime guarantees and legacy, usually whole life. Flexible permanent coverage with index-linked growth potential, that's going to be an IUL. Protect the house, usually that's going to be mortgage focus or a term. Final expense whole life If you want a personalized side-by-side with your numbers and timeline, there's a link below to book a quick call. Features, riders, eligibility, and underwriting vary by carrier and also state. Index link crediting in IUL is subject to caps, participations, and is not direct stock market participation. Loans and withdrawals reduce values and the death benefit and may cause policy lapse. Dividends are not guaranteed. All policies include a standard contestability period and suicide provision per the contract and state law. Always review the illustration and disclosures. Thanks for watching. Now that you know the landscape, you won't get sold. You'll spot the pitch, ask sharper questions, and choose on your own terms. If this helped, please like and share. Grab the free Waiting Periods Explained one-pager in the description. And if you want help choosing the right path, book a time below. We're here to make sure your family is better protected and better informed than before we met.